Welcome back to Market on Close. I'm Oliver Rennick as we continue to assess the contour of this market on a day that's headed for the red. Once again, I want to bring in Bob Iaccino. He's the founder and chief strategist of Path Trading Partners. Bob, we got a lot here to make sense of, but little time, so let's get to it. What do you make of this market here today, especially given that crude once again is kind of the saving grace?
Yeah, I guess the energy sector being down about 25, 26 basis points is a good thing considering the sell-off we've seen in toward the end of the day. Crude oil, I'll tell you, you can stop me because we've talked about it a lot, but that seasonality, I know it seems like there's other factors driving it, but when you look at a seasonal chart, and you could look at them at equity clock, you could look at them at trendy trade, you could look at wherever you want to look at them, you look at those seasonality charts, and the steepness of that seasonality is because of the reliability of it. Now, I've never cared about why something moves. I just want to be able to figure out if there's some consistency to it so I can trade it. And it's playing out almost exactly as the way the seasonality charts play. Obviously, the John Bolton thing's a big deal. Put a floor to us. We got 5 more rigs. But again, still these rigs are not expected to be performing quickly, or at least as quickly as Venezuela is degenerating.
Hey, Bob, why the discrepancy between the adding on of rigs here in the U.S. and the drop in Canada? It's really offset down to 160 compared to 219. We touched on this, I believe, the last time we saw Baker Hughes because of the overall Canadian economic picture, which is not as strong. But what's happening here?
That's a transport issue with the Canadian sands.
Okay.
And that's the big thing. As we get, we are not getting approval or funding for some of the pipelines that President Trump wanted in place. So it becomes a transport issue, and we're getting less and less. It should stop because we're getting less and less crude from the Middle East. That fell 14% month over month, imports into U.S. refineries. So we should be driving more of the Canadian sands down here, although it's a different viscosity oil, so you get fewer product out of it. But that should be flipping. It's a bit of a mystery, but it's not really affecting the price versus U.S. WTI. That's a pretty fixed spread between WTI and Canadian sands.
There you go. And we were just looking at the seasonality there on oil. You can kind of see what you're talking about, that kind of spring move, if you will. Bob, I want to talk also to get your take about what's happening in the currency markets, the yen in specific, because you see some strengthening. Is this some kind of safety move, the days of yore, safety yen, or is this kind of an unwind to carry trade? What do we make of this?
Well, it's a safety play. Absolutely, it's a safety play, as well as the more consistent economic data versus what their central bank says they're going to do and probably should be doing. You look in the last 5 months, the yen's up over 8%. That's a good size move. We were at 115 or so, 114. 5 months ago versus the U.S. dollar. Now the BOJ has 1.5% inflation today. Core inflation up at 1% for the first time in over a decade. That 1.5% headline number is a 2 3/4 month high, and the BOJ is starting to talk about potentially moving accommodation for the first time in a century and a half. I mean, it's been a long time. So the Japanese situation with the flight to safety that the yen has become over the last, say, 10 years or so, and the position their central bank is versus a finally slowly growing economy and inflation number, you're seeing that yen strengthen. It's appropriate.
It's an incredible chart looking at the yen here the past quarter. Is that the reason, Bob, why we can't get any bid in the dollar, even in what we're looking at here for strong data and all that type of input?
Certainly one of them. I put out a piece on, I think it was about March 7th, that one of the negatives, well, I don't want to say negatives, but the push on the dollar, the push on yields, and the push on U.S. equities is a trade war. I mean, that's what's happened historically. That's what happens. The dollar goes lower, yields go lower in the treasuries, and stocks go lower. That's happened consistently. We have a trade war now.
Yeah.
Now, we've got China versus the U.S. versus China, I should say, because we kind of picked the fight, I guess. But China acted really
Depends how far you go back,
calmly,
Bob.
honestly. Truth. I mean, the intellectual property was argued before WTO. China was found guilty. So was some little minor price fixing. You could probably argue some major price fixing on China's behalf. However, they responded sort of gingerly. 5% of what Trump is putting on them.
Yeah.
$3 billion in tariffs versus 60. So I think right now China does not want to disturb the international stage because they're focused on domestic projects and they're focused on ramping their GDP up back to that double digit we haven't seen in a couple of years.
Yeah.
So I think they don't really want to walk the boat. They had to fire, but it was a cannon versus a handgun.
All right, there we go. A great one to leave it on. Bob Iaccino, have a great weekend, sir. Glad to have you here. Bob's the
You too,
founder.
Oliver.
Thank you, sir. And chief strategist at Path Trading Partners. Coming up, it's time for the closers panel. Stick around. We got a lot for you.